Some investors are worried about the gold market today. We've seen a 2 years correction now, and some believe that the market has actually finished, the bull market, and we're going to have a pretty difficult time for gold. Well, I will tell you that in my view nothing has changed. The gold bull market is still alive, and we are going to see substantially higher prices in the next few years. So I will take us through a few slides here to explain why and what I see happening in the next few years. So let's have a look at first some historical figures. US inflation for the last almost 250 years. From late 1600s to early 1900s, US inflation was virtually non-existent. It was between 1% and 2%. Then the Fed was created in 1913, and then of course we had the Nixon abandoning the gold backing of the dollar in 1971, and you can see that in the 1900s the growth in inflation, which this chart shows, is exponential. If we look at credit growth over the same period, it was exactly the same. So what I'm saying is that what has happened in the last 100 years since the creation of the Fed is not normal, and abnormal things do not last. And this spike up in inflation is likely to end in a very sharp correction. So this very sharp spike in inflation, and as I said, it is also the same in credit growth, will end with a major correction and a major implosion of both inflation and credit markets. Now, if we look at what's happened to currencies in the last 100 years, this chart shows gold as a straight line with all the currencies falling against gold. Now, every single currency has fallen between 97 and 99% against gold in the last 100 years. Why? Well, because of the money printing. Every major country is destroying the value of its money. And gold is reflecting that by maintaining, as it has done throughout the last 5,000 years, by maintaining its purchasing power. And if we look at the dollar, which the reserve currency of the world, well, the dollar doesn't deserve to be the reserve currency. Just look here at the dollar against real money, against gold. It's down 80% since 1999 only, 80% in the last 13, 14 years. But then we can look at the dollar against the Swiss franc. The dollar against the Swiss franc has gone from 4.30 in 1970 to 90 cents, 90 Swiss cents today. So the dollar is down 80% against the Swiss franc. The dollar is an extremely weak currency that will continue to lose value against every single other currency in the world, and obviously against gold also. So some people think that the stock market is the place to be, but this is a chart of the Dow Jones against gold in the last 200 years, and as you can see, the trend has been a rising Dow against gold. But since, if you look at the peak, the last peak there, which is around 2000. Gold is then at the bottom of 250, and the stock market then relatively strong against gold. Since 2000, the stock market has gone down 77% against gold. And in my view, if you look at the arrow at the bottom, we have another fall of at least 90% of the stock market against gold. So in real terms, the stock market is overvalued. It has protected investors before from the destruction of paper money, but that race is now done in my view, and we will see gold strongly outperforming the stock market in coming years. Now, just this graph shows the commercial property in the US against gold, and again, commercial property since 2000 has fallen about 60%. So again, that's not protecting investors either against the fall in the real value of most assets. Stock market so far has been reacting to the printing of money. Here we show how the Fed's balance sheet is expanding and has gone from under $1 trillion to almost $4 trillion in the last few years. And as we can see in this graph, from 2008, the increased QE, i.e. the increased money printing, has had a direct correlation with the stock market. So stock market is just benefiting from liquidity, and as it actually has done at the beginning of every hyperinflationary period throughout history. So at some point in the next year or so, the stock market will stop reacting to or responding to the printing of money, and I see the Dow coming down with other stock markets dramatically in a secular bear market that is likely to start sometime in 2014. In spite of all of this, central banks and governments have no other solution than to print more money. Bernanke has promised it. Yellen will continue with the same policies. So the money printing will accelerate in coming years. There's no question about it, because that is the only thing governments and central banks know how to solve the problem, and it is not a solution. We have to remember that. It's just kicking the can down the road. This chart of US debt and US deficit is probably one of the most important charts that in one picture describes what's happening in the US and therefore in the world. We see US debt in 1980 here being around $1 trillion, and US fiscal revenue, the green part, also being around $1 trillion. Since 1980, fiscal revenue has grown to just over $2.5 trillion. That is 2.5 times, whilst debt has grown from $1 trillion to $17 trillion. So you can see, in spite of printing massive amounts of money, and now at an increasing rate, in the last few years it's been at around an average of $1 trillion a year, the US is still running a major deficit. So the country is printing more and more money, and still tax revenues are not going up. So then you have to ask yourself, how can this debt ever be repaid when tax revenue is not increasing and the deficit is just continuing to run at a very high level? Well, I think this graph, more than any other graph, explains why the US is bankrupt. Because there is absolutely no possibility of repaying these debts with tax revenue. Instead, they will need more debt in order to just stand still. And that, of course, is what the Fed has done in the last 6 years, or in the last 6-7 years, and what Bernanke has done. When Bernanke became chairman of the Fed in 2006, the US debt was $8 trillion. Today it's $17 trillion. So Bernanke is the most productive man in the world. He has created as much money in his 7 years as chairman of the Fed as it took the US to go from 0 to $8 trillion, which was 200 years. So Bernanke has done in 7 years what it took the US 200 years to do before. And of course, we can see that GDP is only increasing by, during this period, 24%, whilst debt is going up by 100%. Now, So we are reaching a point here where the printed money has less effect. If you look at this chart here, which is the law of diminishing returns, at the beginning of the last century, or the first 50 years, every dollar of debt created $4.60 of GDP. Today, we're down to virtually no increase in GDP for every dollar of debt. So the money printing has ceased to have any effect, and the US is pushing on a string. Now, the other problem, which has not been resolved and it is of the same magnitude as before, is the derivatives. We have today around $1.4 quadrillion outstanding in derivatives. A major part of that has a value which is substantially below the level it is valued at. Thus, that will become a major problem for the banking system and for the world. And because this level is about 15 times world GDP. It's just astronomical. This cube here shows all the gold ever produced in the world, and then all the gold held by central banks in relation to the derivatives. So even if we had gold-backed currencies, you could see that gold would have to increase substantially in value in order to cover potential derivative losses. Now, the world has never seen a situation like we're in before in history, where major nations, the West, the US, Europe, Japan, even China now, which is increasing its debt exponentially, banking lending is going up by a very high percentage. So you have a situation where banks are under real pressure. The 2008 problems and the Lehman crisis, nothing that happened at that time has been solved. It has just been deferred. The problems are still there, the debts are still there. Some of the banks have cleaned up a little bit in some countries, not in Europe. The banks are under enormous pressure in Europe, a little bit better in the US, but the US has several hundred trillion of derivatives, the US banking system, which is a major problem. So you have the banking system under pressure, and as I said, it is as bad, if not worse, than in 2008. And you have governments printing more money, a lot more money than they had done in 2008. So the whole system is just growing and growing by printed money and debt. So in my view, we are likely to have another 2008, but the 2008 was just a rehearsal, and the next time it will sadly get a lot worse, and I think we're not that far away from that. So again, this is why holding gold to protect yourself against these enormous risks is so important. And what are the risks? Well, the risks are that currencies will continue to fall. That is almost guaranteed. In my view, we will have a hyperinflationary depression that will start by currencies collapsing and governments printing endless amounts of money. Every single incidence of hyperinflation in history has always arisen as a result of collapsing currencies. And as I've already said, currencies are down 97 to 99% against gold in the last 100 years, and they will now soon start the last fall, which will lead to the hyperinflation. And the consequences for the world will be very serious. Throughout history, we've had different kinds of money. We've had money like the Zimbabwe dollar, that became worthless. We have money like the dollar that is on the way to become worthless. And we have gold, which has been money throughout history for 5,000 years. Interestingly enough, that $100 in 1971 bought that 100 grams, which is about 3 ounces of gold in 1971. Today, you can't even buy a little corner of that gold bar for $100. Gold has now been going up for over, since 1999, so we're talking about 14 years. The interesting thing is that in spite of this major increase, nobody owns gold. There is only around 1% of world financial assets invested in gold. This is why I call it a stealth market. People haven't discovered gold yet, except for a few wise investors. That time will come, and that time is not far away. And of course, there isn't more gold around, and there is nowhere near enough gold to satisfy additional demand, nor to satisfy all the paper claims of gold that is outstanding, that can never be paid out in gold. So therefore, in the next few years, I expect a major squeeze in the gold price, which will mean that we will see rises that are hard to imagine today. But I've talked about so many times how to invest in gold. Gold should only be held in physical form. It should be stored outside the banking system. It should be under the direct control of the investor with no counterparty risk. Any other form of gold, ETF, paper gold, etc., is not wealth preservation. And of course, as regards the level of gold, every investor will have to decide for himself. In my view, an investor should have enough physical gold to fall back on as insurance if other assets decline substantially. That it is today more important than it's ever been to protect your assets by holding an important part of the assets in gold and stored outside the banking system. And if you haven't already invested today, the prices we're seeing right now will probably not ever be seen again in history. Thanks very much for listening to me.